Here we go. KING-KAMBUF, 100 proof, bringing you nothing but the truth. Property and casualty insurance. Still in Unit 3. Federal laws and regulation. Let's get into it. Fair Credit Reporting Act, FCRA, 15 USC, Section 1681 to 1681D. The Federal Fair Credit Reporting Act requires consumers reporting agencies to adopt reasonable procedures for exchange information on credit, personal insurance, and other subjects in the manner that is fair and equitable to the consumer with respect to the confidentiality, accuracy, relevance, and the proper use of the information. All insurers and the producers must comply with the Federal Fair Credit Report Act regarding the information obtained from a third party concerning the applicant. Reports on the consumer are prohibited unless the consumer is made aware that the investigation consumer report may be made, and such that a report may contain information about the person's character, reputation, personal characteristics, and lifestyle. A notice to the applicant must be issued if all applicants are property or casualty in life or health insurance coverage. This notice informs that the applicant that the report will be ordered and concerned to this credit history and the other life and health insurance of this switch and have previously applied. The agent must leave this notice with the applicant along with the receipt. This notice has been given to the consumer no later than 3 days after the report is requested. The consumer may have a written request for the complete disclosure of the nature of the scope of the investigation underlying the report. Disclosure must be made in writing within 5 days after the date of which the consumer request was made. Consumer rights. Consumers who feel that the information on their files is inaccurate or incomplete may dispute the information, and the reporting agencies may be required to investigate and correct or delete information. Insurance companies may use consumers' reports as investigated consumer reports to compile additional information regarding the applicant. If the applicant feels that the information compiled by the consumer investigation service is inaccurate, they may send a brief statement to the reporting agency with the correct information. Penalties. Violators of the Fair Credit Reporting Act may be subject to fines and imprisonment and may be required to pay in actual damages suffered by the consumer, punitive damages awarded by the court, and reasonable attorney fees. The maximum penalty in obtaining customers' information reports under false pretense is $5,000, imprisonment for 1 year, or both. Fair Credit Reporting Act. Fair Credit Reporting Act. All issuers and producers must comply. Notice to the applicant within 3 days after report was requested. Maximum penalty $5,000, 1 year in prison, or both. Terrorism Risk Insurance Program Reauthorization Act of 2019. TRIPRA. As a result of the Terrorist Act of the United States on September 11, 2001, Congress enacted a presidential signed into law the Terrorist Risk Insurance Act, TRIA, of 2002. It was reenacted in 2007, 2015, and 2019. The title of the act is now the Terrorist Risk Insurance Program Reauthorization Act of 2019, TRIPRA. They extended the program through December 31st of 2027. The federal law defines acts of terrorism as impose certain obligations on the insurers. The definition of terrorism is a violent act or an act that is dangerous to human life, property, or infrastructure that results in damage within the United States or outside the United States, committed by either a domestic or foreign terrorist. An act of terrorism must be certified by the Secretary of the Treasury and consulted with the Secretary of Homeland Security and the U.S. Attorney General. Until recently, the Secretary of State rather than the Secretary of Homeland Security was a federal official who were part of the certification process. This act is designed to limit the exposure of individual insurers and insurers industry as a whole and to make insurance available and affordable under the system where the federal government participates and the shares of risk is lost. In the several key provisions acted in the act, the trigger the event for the program to go into effect was $100 million and increased to $200 million from 2015 to 20 in $2 million increments. Six insurance carrier deductible is set at 20%, and their direct earning premiums from the prior calendar year at this. This is the amount the insurer must pay before the federal government provides compensation. The federal shares of compensation that exceeds those deductibles decrease from 85 to 80 by 2020. The aggregate retention in the insurance market increased to 27.5 billion to 37.5 billion by 20. In the insurance market aggregate retentions amount was established to 37.5 billion, the cap on the federal liability to note that exceed 100 billion. TRIPRA, TRIPRA. TRIPRA results in 9/11 attacks on the U.S. Congress originally enacted it in 2002. Limits exposure of insurance in cases of another catastrophic event. Triggered event 200 million. Graham-Leach-Bailey Act. The Graham-Leach-Bailey Act, the GLBA, was passed in 1999 to allow financial holding companies to engage in activities that are financial in nature. Regulation of these holding companies is managed in a functional basis. This means that regulatory authority is based on what activity is occurring rather than what the type of company is engaging in or activity. This is, for example, the sale of insurance is regulated by the state insurance regulatories. Even if the company is making a sale is a bank and a securities and brokerage. The GLBA requires financial institution companies that offer consumer financial products or services like loans, financing, and investment advice, and insurance companies to explain their information sharing practices to their customers and to safeguard sensitive data. Financial holding companies have the potential to capture unprecedented amounts of information about their customers. To address these concerns, the GLBA also establishes a minimum federal standard for financial privacy. GLBA states that each financial institution has a responsibility to respect the privacy of its customers and to protect the security and confidence of those customers' non-public personal information. At this, the law requires that all functional federal regulatory agencies establish appropriate standards for each regulatory institutions with respect to the technical, administrative, and the physical safeguards to ensure the security and the confidentiality of the customer's records for information. Practice protect against any participating threats or hazards to the security or integrity of such records and the protections against authorized access to the use of such records or information that could result in the substantial harm or inconvenience of any customer. Anyone about whom the company collects information is a consumer, a customer. A customer is whom is going on relation in a financial institution. Different states define ongoing relations using different guidelines. So be certain you understand what it means in your state. The opportunity to opt out must be offered by the financial institution when an account is established in the annual thereafter. The GLBA protects the confidentiality of the personal information. The acts considered information to be collected when it is organized or can be retrieved by the individual's name or by the identifying number, such as the policy number. The source of the information is less important than how it is stored and organized. Information is that public available, such as phone numbers listed in the telephone book, is not protected under GLBA. However, the fact that the individual has an insurance policy with a certain company is not public information. So, publishing this list of policyholders' names and list phone numbers would not automatically be allowed. Business information is not covered under this statute. Graham-Leach Bailey Act. Consumer customer. A consumer is anyone who information is collected. A customer is someone who has an ongoing relationship with a financial institution. The opportunity to opt out must be offered by the financial institution when an account is established about and annually thereafter. Fraud and false statements. 18 USC section 1033 and 1034. A person who transacts insurance in the interstate commerce and who intentionally makes false material statements in connection with the financial reports or documents present the insurance regulators appoint to the investigative and the person in attempt to influence the actions of such officials is subject to fines, imprisonments for up to 10 years or two, and both. The imprisonment may be ordered for up to 15 years if the false statement jeopardizes the safety and soundness of the insurer and were significantly caused by the insurers being placed in the conversation, rehabilitation, or liquidation by the court. Officers, direct agents, and employees of the insurance companies who willfully embezzle or misappropriate funds are subject to the same consequences described above. Fraud and false statements is illegal to make false statements. If guilty, fine up to 10 years in prison or both. Up to 15 years in prison if the false statements jeopardizes the insurer. Stop fraud. It is illegal to make false statements. If guilty, fines up to 10 years in prison or both. Up to 15 years in prison if false statements jeopardizes the insurer. Under the Fair Credit Reporting Act, the maximum penalty for obtaining consumer information reports under false representation is $10,000 imprisonment for 1 year or both. An act of terrorism must be certified by the Secretary of Treasury in consultation with the Secretary of Homeland Security and the U.S. Attorney General. That's the answer. Which of the following acts requires financial institutions, companies that offer consumer financial products or services like loans, financial or investment advice, and insurance companies to explain their information sharing practices to the customers and to safeguard sensitive data? That's the TRIPA, ain't it? Is that the TRIPA or no? That's the GLBA, because the TRIPA is terrorist act. The GLBA is the Graham-Leah-Bailey Act, and that protects the consumer. 4. Imprisonment may be ordered for up to how many years if false statements made jeopardize the safety and the soundness of the insurer and were a significant cause of the insurer being placed in conservation, rehabilitation, and liquidation by the courts. 15 years. Lock them away. Throw away the key. This is KING-KAMBUF 100 proof, always bringing you the truth. This is KING-KAMBUF 100 proof, always bringing you the truth. 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 We on a nation building effort. We studying property and casualty insurance right here because this is foundation building, sons. Next video, Unit 3, the crown. Oh man, KAMBUF.